One of Wall Street's most influential analysts, Stephen Tusa, downgraded GE this morning, and I know you have got a lot of thoughts about that.
Yes, I sure do.
We also have Warren Buffett's interview with the Financial Times about Wells Fargo and what he thinks they should do with their next CEO, and we've got Pinterest IPO, which is really interesting because you wrote about this, so we're gonna have to get into that. So, you know, everyone has a lot to think about here, and I want to kick it off with Stephen Tusa because that's the news of the day.
Yeah, I mean, I've been back and forth with Steve, and now here's the issue. It really has to do with the run-up of the stock, which he thinks was done for no reason, given the fact that if you've been buying the stock, you see it theoretically been buying because there's 2020, so 2019 was a reset year, 2020 is going to be better. And the theme of the piece is basically, if you really analyze the free cash flow, you're not going to be able to get a great year in 2020. Remember, he has great respect for Larry Culp. So do I. Larry Culp has great respect for his work. But this basically says if you strip away a lot of the one-times, you'll find that the cash flow is not as good. And it calls into question whether it can do well in 2020. Steve does quality work. I have always said that you got to be very careful going against him. David Faber, my partner in Squawk in the Street, says, she says, look, the stock just went from 6 to 10. He missed that entirely, so now he goes to sell. Look, I always remember when at 28 he was against it, but David does have a point. Why didn't he upgrade it at 6? But he's just got a firm view. Steve's got a firm view that next year's not going to be a good year, and a lot of that's power.
Why didn't he have that view back in December?
Well, he's been negative, and look, the stock ran up on the idea that Larry Culp is very good, and that he did sell that high-end part of the life sciences to Danaher for a very good price, and I think that alleviated a lot of pressure. But Tusa still thinks there's insurance issues, and there's power issues, and I don't think that Culp would deny that. But when Larry came on Mad Money, he stuck by that they're going to solve the problems this year, and I think the world of Larry, and I think that the Tusa piece is too negative a tone, is the way I would put it. Too negative a tone. Too negative a tone.
Okay, so I just want to make sure that everyone understands here, because Stephen Tusa upgraded GE back in December. Now he's downgraded again, cut the price target from $6 to $5, and it's our real money stock of the day. So Kevin Kern, our real money reporter, is going to be doing comprehensive coverage. He already has a piece out on a walk-up of what to expect from GE. Now,
this is important because, look, a lot of people are in the stock. It's a 10. I own it personally because I was paid in GE stock for a while. Obviously, it's bad, but it was a gift kind of. But no, it hurt. And I look at GE and I think, okay, you're really betting that a fresh face is going to come in and fix a lot of the culture and fix a lot of the issues, and that have bedeviled the company, particularly when you're talking about power. Aerospace is very good, healthcare is doing well, and power is a problem. So I think if he solves power, then 2020 will be a good year.
Now, before we switch over to Wells Fargo, I just want to remind everyone that if you are in GE, like you are, you can find way more coverage on it at realmoney.com. Again, Kevin Kern's writing over-the-wall reviews about it.
Yeah,
okay.
I mean, look, the piece itself is one of the longest pieces ever, and Kevin's stuff, I think, will distill it. I mean, I was going back and forth with the GE people, and I haven't been able to read the whole piece yet because it came out this morning. I was busy reading the healthcare piece that Katie Huberty put out, which is also long.
Which we're going to be talking about over on Actual Alerts Plus.
This is a day where there's far more research than you can read. It's almost as if everybody woke up and said, you know what, stocks have had a big move, I'm going to reassess. And most of the pieces were negative.
You know, Jim, I remember News Dump Fridays. Now, today it feels like a News Dump Monday. So, speaking of news dumps, Warren Buffett sits down with the Financial Times. He says that he does not believe that the next CEO of Wells Fargo should come from JP Morgan or Goldman Sachs. And the company itself has said that they're not looking for at anyone within their own ranks. So does that mean that an outsider should come in?
Yeah, I mean, there's a lawyer running it now who's really from outside the ranks. It wouldn't surprise me if Alan Parker wanted the job that he didn't get it. I mean, he's a general counsel and he's a very smart man. He could do well. I had opined on the morning show that perhaps they should pick a technologist. Chavez from Goldman would be interesting, but again, he doesn't want a banker. So maybe you go outside and you get someone who, from Informatica, who does great software work, or maybe you get someone from Salesforce, which has done a lot of banks, or from Workday.
And they understand the technology side of it?
Yes, maybe someone from Dell, which has a lot of business, or someone from IBM, maybe a Jim Whitehurst, who used to run an airline and now runs Red Hat, which is going to be bought by IBM. He's going to stay for a bit, but Whitehurst might be an excellent pick. This is one of those, I'm not on the committee, and I think that what you're on these committees, they tend to be very cloistered about who could be picked, but Whitehurst is a natural.
And I think that everything that our audience can agree on, we're all wondering, do you agree with Buffett on this?
Look, I thought that Tim Sloan was doing a very good job. Now, Tim was an insider, but to get to the root of what was the problem, I think an insider actually had a better call. And I think Tim was quietly analyzing the situation, not trying to tear the culture up. Why do I say that Tim was the man? Because the business is very good. Now, it's amazing that he was able to do all the brooming that he did and still have the business good. So I feel bad for Tim, but the fact is that you have regulators up the wazoo, and they were going to crack down on Wells. And it's just, Tim always said that if his troubles were to reflect badly on Wells, then he would resign, and he did. Total man of his word. I don't know who they should pick, but I do know if you're going to go outside, there's technology, there's legal, okay? You know, you get a lawyer, you get a tech guy, or you get a lawyer, or you get a finance guy, and I would prefer a tech guy.
And for members who are curious about Tim Sloan's retirement and what that meant for Wells, you just wrote a piece last week, 2 weeks ago, about Tim Sloan's retirement and your opinion on it.
Yeah, my opinion remains that the man did a good job, but Washington's just never going to let this thing go.
Okay, let's switch over to IPOs, because that's the other big headline today. Pinterest is setting their price target about $15 to $17, right, which is way below what we expected.
Yeah, you know what, Pinterest, did they learn from Lyft? You know, that's something, and we'll talk about that. But I do believe that Pinterest, to do a down round, so to speak, is basically to say, listen, we want the liquidity. People want to get out 6 months from now or whatever. The growth here is extraordinary. The decline in the losses is very good. It's a very interesting company. If I were trying to get stock, I'd probably want to get some stock on this. It's not going to be red hot anymore. But I think when I say red hot, I mean it shouldn't be after what happened with Lyft. But if I were watching and I could get some Pinterest, I would do it.
Let's rewind. You wrote a couple of weeks ago about the oversupply. This was on Real Money. You wrote about the oversupply of IPOs in this market. Do you think that this Pinterest pricing is due to that?
I just think that they recognize that, let's say you're a Lyft rider and you like Lyft, so you bought some stock and you lost a lot of money. Maybe you go to Uber. These things, I say this because I go back, remember in 1999 I brought a company public, and we were uniquely conscious of the fact that people loved TheStreet and therefore they wanted to buy stock, and they lost a lot of money. And so it was something that I hated. I tried to get the stock to open lower. I had no effect. I think that this is something that will make people who like Pinterest and want to buy stock, it'll make them feel better.
I want to continue on IPOs for just a minute more. Let's talk about Levi's, because Levi's is going to be the first company to release an earnings report of this IPO slew.
We favored Levi's. We felt that the trajectory was really, really good when we did our Know Your IPO on, thanks Ben Stoto, on Mad Money. We think it's a very good stock to own.
But
I mean, I also like apparel. I remember going into Matthew Boss's retail conference, and I think that's going to be a reset. I think people are going to realize that the economy is a little stronger, so that's a very good situation. I don't think Levi's is going to jump too, but I just think that Levi's is like Yeti. And Yeti was one of our favorites. No one was really focused on it, and it was just a big win.
So let's take this from an educational angle.
Yeah.
When a company that just IPO'd releases its earnings report, what should investors expect from it?
Usually what happens is the first out of the chute is a good quarter. In other words, they had a really good look at it, and they came public, and they didn't want to disappoint from the get-go. So I think it is. I think it'll be fine. For one moment, I just want to talk about something that you tweeted this weekend. You tweeted that you liked Carlton English's reporting. Now, Carlton worked at TheStreet. She worked with me. Why don't you tell people what you liked, because it's very important.
So the reason that I tweeted that out was because Carlton English and the team at the New York Post was reporting on Lyft and Morgan Stanley. Now, it seems like we're not sure here. This is all just sources. but it seems that Morgan Stanley has been allowing people to hedge against Lyft, and Lyft's upset about that.
Right, well, because then you start wondering, is that why the stock did so badly? Remember I said that I looked at all, I've been around, I've looked at a lot of IPOs since 1981, and typically that one would have opened at 100. People were mad at me. I said 87 is a good price. It was about to open at 100. No one wanted that. It didn't. It still opened too high, but you typically have tremendous demand after. Instead, what you had was aggressive short selling after, and the short selling continued all the way down. Morgan Stanley, unequivocal denial that they did that. CNBC had that story, but I think that what you have to understand is that that the Lyft deal was considered to be very bad in a lot of different ways, and some people are saying, well, that was because they allowed people who are in it. These, you have a whole new class of stockholders now. I mean, typically you just had venture capitalists, and they come public, and the venture capitalists wait 6 months. Now you have a lot of hedge funds. And the impression that the reporting gave was that some of these hedge funds got liquidity when they normally wouldn't get liquidity. Now remember, a product like this, some people would say is illegal. So I would say people have to pay close attention to the continuing story because Morgan Stanley does deny it.
And it's interesting because one of the big things that, I don't know if viewers are watching this, one of the big things that's been going back and forth on Wall Street is whether or not we're ready for a gig economy company to go public. And that was said to be one of the reasons that there was such short selling interest. But this story allows a whole new window. So we have to keep an eye on this, and I agree.
Do you use Pinterest?
I do. Not as much anymore.
Okay.
I used to use it more.
How did you use it?
I use it for clothes.
Really?
Yeah.
Okay, because one of the things that Carl Quintanilla said was that 90% of the users are Pinterest. I'm not a pinner. I looked at it obviously for because the prospectus talks about it. I use Etsy a lot. What's the difference between Etsy and Pinterest?
I would say they're more alike than you'd think, because a lot of the time if I'm looking at, say, a piece of clothing or a piece of jewelry and I go to click on the pin, it'll lead me back to the Etsy seller. So
Really?
It's almost like free advertising
Really?
for the Etsy user.
Oh, that's interesting. Okay, because I use Etsy to find things, we use Etsy, my family, that are not in the mall. And
I agree, same.
Pinterest seems very creative and also international. So I think that one of the things that's happened with this S1, that's the document, is that you find yourself more interested in Pinterest as a product. So if you take a look at the S1, and I do advise you do it, the first 10 pages are about how people like Pinterest, and it was fun.
And it's one of those things, Pinterest, I find so many of my gifts through it, and then I go on
Right.
Etsy and I buy them. So they do complement each other a lot.
Okay, so let's all take a hard look at Pinterest.
All right, Jim, thank you for joining me. And if you're watching us on Facebook or on TheStreet.com, we're now jumping over to our Action Alerts Plus video. You can find us over on ActionAlertsPlus.com. We are going to be talking about Apple because Katie Huberty's note, as you mentioned before. And we've got a whole other thing, and we've got 3 member questions.
Right. Now, people should understand, this is the free, and then when we talk about Action Alerts, that's paid, but that doesn't mean you can't trial us. And the reason I mention that is because I got a very important call on Friday where I really, I'm going to talk about how to play earnings season. Now, it is the first day. So I think that those who want to understand how to get through earnings season, this will be a nice tutorial. So and it'll be exciting too. So I really want to encourage people who are not members of the club to sign up, and you can watch our next video. But most importantly, you can watch what I think is going to be a very good call.
And if you didn't know, JP Morgan reports that morning, Friday morning. And Wells. So he's going to be breaking down what to expect from earnings.
It's going to be instant, but we're going to show you how because we own JP Morgan, how we approach it ahead of time.
So if you want an inside look, check out ActionAlertsPlus.com and sign up for that free trial. All right, guys, thanks for joining us. We'll see you tomorrow.